Time once again to check on the latest earnings trends with Zacks Director of Equity Research, Dirk Van Dyke. Dirk, as we start another earnings reporting period here for the fourth quarter of '08, we sit back and we look back from the beginning part of 2009. I'm reading a lot of mixed views on where corporate earnings are headed here. Just to let you know, I'm seeing some analysts expecting an increase or a snapback in 2009 earnings. They say helped by the financial and consumer discretionary sectors, which did take a big beating in '08. Still others are saying that '09 is going to represent the trough for earnings, putting forecasts anywhere from a decline of 18% to an increase of 26%. Where are you at in that span?
I would be closer to the decline of 19 than the
18,
or 18 than the increase. I think anybody looking for an increase in overall corporate profits this year is borderline delusional.
Okay. How slow will earnings be to recover? Any way to predict from this point?
Hard to say what 2010 is going to look like. I mean, we'll probably see some growth in 2010 over 2009, but whether that represents a real sustained growth, it really determines on, how bad 2009 is.
Forget about recovery. Let's talk about stabilization. Any way to tell when corporate earnings might begin to stabilize?
Well, I mean, a lot of that depends on the view of the economy. There are some people out there expecting a second half recovery, to which my main question is second half of which year?
Well, what I'm hearing is second half recovery in the stock market, second half of '09, but then economic recovery not till 2010.
Yeah, I mean, it's 2010. I mean, it depends how quickly the economic stimulus gets passed and how much of an effect that it really has. You've got the desire of people to raise their savings rate, which will decrease the multiplier effect from the stimulus, and we are in a very, very deep hole. I mean, people just don't quite get how screwed up the economy is with the amount of debt built into the system, and the need for consumers to retrench and build up their savings, or the competition for Walmart greeter jobs is going to be intense because nobody's going to be able to retire.
Kind of ironic that if Americans have in fact learned their lesson about the importance of saving versus spending, as I'm seeing studies show, and you are as well, that it comes at a time, exactly at a time, when more money is needed to be pumped into the economy, so spending should escalate.
Almost always the case. I mean, that savings rates almost always go up in a recession, if you look at the chart, but it makes life even more difficult. John Maynard Keynes wrote extensively about this, and it's what's known as the paradox of thrift, where what is good for an individual to try and be frugal and save means that the economy slows down, there's less jobs, less income. If you've got less income, it's a lot harder to save, but then everybody gets more frightened and wants to hold back, and that's why you need countercyclical spending, in the Keynesian mode. Given the massive level of the U.S. debt and the fact that most of it is now held externally rather than internally, we no longer owe it to ourselves, which was the old sort of mantra. That becomes increasingly difficult. I mean, you sort of are like Blanche DeVoe, dependent on the kindness of strangers, dependent on the willingness of the Chinese, the Japanese, the Arabs to continue lending money to us at exceptionally low rates. Government bond yields are absurdly low. I mean, that is the current bubble.
All right, let's get back to corporate earnings. Will the financial and consumer discretionary sectors be the bright spots for '09?
They have the easiest comps, that's for sure. I'm not convinced that all has been revealed in terms of the financials and the write-downs. Yes, the residential side of the equation, residential housing, is probably mostly priced in, but commercial real estate is about to go into the tank, and an awful lot of the smaller regional banks, the sort of, 10 billion in asset type banks, have huge exposures to commercial real estate. As that goes into the tank, they're going to have to take some major write-offs. Corporate, you're going to see a big rise in corporate bankruptcies. All that is going to weigh on the financials. But they do have exceptionally easy comparisons. Consumer durables, in terms of the total overall earnings, the discretionary, you look at who's in that group. Do you really think the autos are going to have a banner year this year? I certainly don't. Retailers, if consumers are pulling back and trying to save, people are going to start shopping their closet. And, perhaps, technically apparel is a non-durable good. You can look in your closet and find something that's 5-6 years old and is still functional.
So still an iffy situation for those two sectors. Let's back into the fourth quarter, which is the quarter at hand, and focus on that a little bit. You tell us that 21 firms have reported so far as fourth quarter is concerned. And of those 21 firms, what have we seen?
Well, the total net income, if you add up all their earnings, is down 97% from a year ago. Now, that's not quite fair in that almost all of those losses are confined to two firms, Morgan Stanley and Goldman Sachs. But, just about every sector is down in terms of total net income. Ironically, the one that's up just really marginally, essentially flat, is consumer discretionary. The surprise ratio is still more positive surprises than negative surprises, but it's only less than 1.4 on the ratio. That is far below what we've traditionally seen. Traditionally, it's more like 3 positive surprises for every disappointment. Now, very early in the season,
right.
I wouldn't read too much into this sample size of 21 out of 500.
Right. Season doesn't officially kick off until next week. But you do say that energy, which was the only source of significant growth in 3Q, is going to fade in 4Q, huh?
Yeah, well, you go from $147 a barrel to under $40 a barrel. That tends to do a number on your profitability if you're dependent on selling that commodity.
But that's back on the upswing again. Might that change in first quarter 09?
Still relative to a year ago, you're still well below. But you may start seeing fewer estimates being cut with the in the energy sector if there's some sustained growth back in the oil market. The price of oil has been hurt by a massive decline worldwide in demand for oil. It's not come through massive new supplies coming out. And there's always some geopolitical issues. Russia's issue with the Ukraine and gas prices, current tensions in the Middle East, all those things can affect on oil prices, certainly.
All right. Dirk has done an outstanding job once again, and his staff, I might add, have to give the staff credit whenever possible, of putting all of the numbers together for earnings and EPS revisions and all of that, median estimate revisions and growth and revisions ratio, and there's just a lot of numbers in this report. And so if you are watching this video outside of Zacks.com, I urge you to go to Zacks.com and go down the homepage and click on the headline, most recent earnings trends headline next to Dirk's picture, and just take a look at the text version of this report. There's a lot of information here that I'm sure a lot of people would be interested in taking the time to see, and so I'll call that to your attention right now, as I do all the time here when we talk with Dirk Van Dyke, Research Director for Zacks Investment Research and Zacks.com. And with Dirk, I'm Terry Ruffalo.